Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. As is usual at this time of year, I will stop looking at my daily charts and instead concentrate on the longer term view, using my monthly, even yearly charts to commentate on a market. If you would like to discuss any of these, I'll only too happy to hear from you. So let me now introduce today's longer term chart. Today I'll be looking longer term at Chicago wheat. Previously here, when I discussed the longer term monthly charts for Chicago wheat, I'd spoken for the last 5 years or so about the morphing of various patterns dating from 2012 to recent times. Principally a descending scallop pattern that morphed into a rounded bottom, that then morphed into an ascending scallop pattern. The last of these patterns, the descending scallop pattern, or ascending scallop pattern, had achieved its downside target in 2022. However, last year I laid out a possible new pattern that emerged and was prompted by the 2-month blip in September and October of 2022. This blip prompted the following discussion in my commentary of last year, and I quote, "I looked closely at this blip up and a much smaller one in late 2021, as well as the big move up in and down during 2022. I've come to see it as a possible new, if an extraordinary pattern. It seems we might have an October 2021 to date, possibly very, very thin and tall head and shoulders top pattern. I'm not wholly convinced, as it is a lanky giraffe of a pattern, but is there with a seeming fairly flat neckline in the 738 zone, just below where we are. Right now we appear to be in the last throes of creating the second shoulder. This pattern is deserving a very close look over the next few months of 2023. End of quote. Now I further added, and I quote, "The next support underneath, well, that will be interesting as it is the 50% absolute Fibonacci line at 682. End of quote. Well, since that commentary, prices have dropped down through the 50% absolute Fibonacci line, as well as the last of the moving average, that's the 5-year moving average, currently at 664.25, and even the 2019 to date uptrend currently at 646.25. However, the market has not enjoyed such a move down in 2023 as it did in 2022, and I think this is due to one reason, a glaringly obvious reason, and one I have already mentioned this year and in the past half decade or so. The market has moved down to the base congestion formed from 2013 to 2021, previously mentioned rounded bottom pattern, roughly, and is very roughly, between 400 to 550. What we've seen in 2023 was the market testing the outlying suburbs of this support, specifically the well highlighted and anticipated bump upwards we saw back in September 2018. So far, even this bump has been enough to turn prices back upwards. But I do not anticipate this to be the end of this testing of the downside. I would pay a special attention to two specific supports within this wide 400 to 550 zone, and they are the 38.2% absolute Fibonacci line at 521 and the 2016 to date uptrend currently at 470.75. It would not be unreasonable to say that between these two levels is where the core of the long-term support resides, below that resides. Now, one final item, and that is to lay out some potential targets below for this tall, thin head and shoulders top. The primary target will be in the 422 zone, a little below the 2016 to date uptrend, but still within the 400 to 550 support zone. However, the secondary, harder to reach, and let me be very honest and open about this, very, very harder to reach target X1. Well, that will be down in the 126 zone. That's right, way off the bottom of my long-term chart. Thank you for watching and listening. This annual broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.